All right, so the Friday before Labor Day weekend ended up being not a quiet day. There might have been some quiet, some expectations of that going into a summer holiday. Not so much, right? It was a pretty volatile day. So I'm going to break down the move of the last couple of days, especially from the context of what we were talking about in Wednesday's Market Outlook video. This idea that we could drop this far this fast, that actually came to fruition by the time the week was done. So now, what do we do? Can we go up this far, this fast again? So I'm going to break down what our expectations are and what this means. We're also going to talk about whether this is actually the pullback or not. Was this the pullback that we've been waiting for? Was it a pullback enough that I can really start loading up on bullish deltas again, bullish trades going forward from here? So we're going to talk about that. And then our trade idea is going to be a stock, an opportunity where we had a nice little pull, where the stock itself has had a nice little pullback, and talk about how to trade it from the perspective and context of the broader market, and be able to see, trade both a potential bounce and then an actual broader market pullback if we ultimately get one. How do we trade that? So that's what we'll talk about with our trade idea. So let's go ahead and get started. Today is Friday, September the 4th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see the decline that we had. We finished with actually a smaller down day, much smaller than what we had at the lows of the day today, well off of our lows, bringing the near-term line down into the lower half of the chart, so new near-term low point. A little bit of a long lower shadow here at the moving average. The intermediate line falling below its market sentiment line, which is also still falling, though both are still above the 80th percentile, which means no light pink shading yet, right? And no yellow line either, because we didn't close. We had a little intraday piercing of the 30-day line, but it didn't quite close down there. But you also see that we didn't even get to the 23% retracement level. So you think this is bad? Like, if you think the last 2 days have been a pullback, then when we actually do get a pullback, it's going to be really bad for you, right? Because this is not a pullback. This is noise. This continues to be noise. We had a really good discussion, technical analysis class today about what is a pullback, what makes up a pullback, and if this actually is one, and what's the dangers of thinking this is one. This is an actual pullback. I mean, of course, we dropped and the near-term line came down, but the intermediate line, like when I say pullback, I'm looking for the intermediate line to get below 50, because again, the typical time frame from low point to low point on the intermediate line is 1 to 3 months. We've been now 5 months since we've had this low point, almost 5 months. That's a long time. So when I say pullback, I mean when that green line gets back below 50. It doesn't have to stay there very long. It can come down and just drop down and come back up. But getting the green line below 50, that gets a stark pink shading and a red line. That's a pullback, right? This is a pullback. This is not a pullback. And this is not a pullback. And a pullback doesn't begin until you break the 23% retracement level, which we haven't even gotten to the 23% retracement. And again, it's usually we don't need to drop that far, because consider that intermediate runs don't typically last 5 months. They're typically 1 to 3 months. So this is a long time frame. We probably should have had a pullback here and more of a pullback here, and we didn't. So this is a very long time frame for the intermediate line to come up without any dark pink shading and a red line. Right, so that's not typical, and the longer this goes, the bigger and the higher it goes. So it's like 83% on the Nasdaq, tremendous return off that March low point. That's not normal either for a 5-month run. So the bigger the run, the bigger the gap between 0 and 23, and I've told you before many times that we can fall between 0 and 23 very easily without any support or resistance holding us. So we can go up and down. It's like we've gone down in 2 days. We can go right back up to this high point just as easy as we came down this past 2 days. In fact, I kind of expect that we will go back up here. That's what we talked about today in our class. The expectations of what will happen here as early as early next week, of what to expect from the market. And again, dangers of considering this an actual pullback where you get the prospects of another 1 to 3 month rally coming off of this. Right, it's a little different over here because we were only a month or two. We could go another month and still be okay, but now we are close to 5 months. September 13th would be 5 months of long. That's very, very mature, and we're getting a lot of overbought clusters at the end, towards what could be the end of this intermediate rally. So those are a lot of signs that are cropping up there. The NASDAQ obviously had, that was our discussion 2 weeks ago in technical analysis. That the more the NASDAQ goes up, its margin of safety looks, from a technical analysis perspective, looks a lot worse. So it's got the most to fall. And as you see, it actually did come really close to its 23% retracement level on an intraday basis. It had the most to fall, and it did. It fell the most out of any of these. But you notice, again, because of the long lower shadow, we don't have any kind of significant short-term sentiment. Not here, not on the Russell 2000. I mean, yes, the near-term lines dropped below 50, but it hasn't dropped below 20, where we'd start to really be concerned, something like this, where we'd start to really be concerned about an actual pullback occurring. So again, anytime anytime the markets can move, and it has multiple times, can move between 0 and 23% without skipping a beat. It can go up, it can go down, it can go up and down. It can move in that range without changing the trend. Just from a noisy perspective. And the longer that we've gone up, the bigger the gap has gotten, which means the noise gets noisier, right? The moves up and down can be a lot more volatile and a lot more noisy. That's why the VIX hasn't moved. The VIX has stayed pretty high. You can expect things to be pretty darn noisy, up and down. And now that we've had a couple of down days, down towards that 338 level that we were looking for, and we bounced off of it, I wouldn't be surprised if we continue to bounce up into next week, potentially even up to a new high, and pushing up, trying to sucker a lot of people into thinking that this is the actual pullback, and really increasing the deltas. And then, if you thought this was painful, like I said, if you think this is a pullback and you thought that was painful, then it's going to be really painful for you when we actually do get an intermediate pullback, where we drop potentially down to 3140, if not all the way down to 3060, down to this 38% retracement level, because that's coming, right? That's the nature of markets. You go up, you come down. It always happens that way. And the more you go up without coming down, the bigger the down, as we've seen in the last couple of years, the bigger the downward move has gotten. And that's been the problem the last couple of years. We've been a very binary market. You're either super bullish going up every day, or you're really bearish. And we've seen that over the last few years. We haven't had, just nice, easy, like this was about the easiest we got. Even that was pretty uncomfortable for people in May. And then we saw this one here in August of 2019. But we're getting more moves, more extended intermediate runs, that we see here, just more and more of these long extended intermediate runs, and more, bigger declines, bigger uncomfortable intermediate pullbacks that people just, aren't uncoming. Again, binary market. We're either going up going up every day, or the market's tanking. And that's, now we're in the phase of going up every day, and this is not the market's tanking, right? This is, I use the analogy of the earthquakes here because we live in the mountains. But, if there are aftershocks typically associated with earthquakes, this is a before shock. I think this is a before shock, like this one was over here pre-COVID. That was a before shock. We went up to a divergent high point, and then we got the earthquake, right? This is a before shock. I wouldn't be surprised if we don't go up to a divergent high point from here before the actual pullback begins. And the nice thing is that it will if you do get this divergent high, it will allow you to get even less bullish at that point, to really take advantage of the bounce. And if you haven't already, because we've been talking about it for a few weeks here, but it should allow you to get less bullish so that you don't, we're not going to get this kind of drop again. But like I said, a drop down to 38% retracement, which is very typical, would be very uncomfortable for a lot of people that are getting in this area, at least chasing returns here in this area. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here, or this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things: you liked our video and you want us to do another one. It's it's a quick way to give us feedback. If you like our videos, if you want us to keep doing them day by day, then let us know, and you can do it with one click right now while you're watching. This with that thumbs up icon. Also, while you're down there, comment. What did you get out of our video today? What questions or comments do you have about our video? Post any of that in our comment section down below. Follow or join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out our Market Outlook Lives. Now, today I didn't do a Market Outlook Live. It's actually included in today's technical analysis class, which all of our subscribers have access to. Premium and Plus subscribers, you all have access to both the Market Outlook Live videos and our trading rooms, including my technical analysis class on Fridays. So you can go check out our trade, or you can go check out the review of all of our old trades, which is what I normally do in these videos. There in today's class. Also, when you come down here, we invite you to click on this heart. It opens up a new window. Hit that like button right there. Same thing here on Facebook. Hit that thumbs up. It opens up a new window there. We invite you to hit that like button as well. Again, the more you do that, the more Facebook and Twitter will promote our content to all of our followers. As you saw in that Facebook post, not everybody sees our stuff. And so the more people that they will make sure everybody sees it, the more likes and engagements it has, retweets and things like that. So that's why we always ask you for it. Also, it benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at the weekly chart. Now that we're done, in fact, let's start off with the market forecast weekly chart and see. I mean, look at that candlestick there. That's an interesting pattern. The bodies are equal size. You got obviously a much bigger range here this week. A little bit of a bearish reversal type pattern there. The near-term line's not down very far. The momentum line's not down very far either, but you can see it's headed lower. So again, can we get another week or two of, again, maybe even just a 23% retracement? We'll see if that ends up being the case. If you take a look at the NASDAQ 100 and look at its weekly candle, same thing. Look at that body, long upper shadow, long lower shadow, actually a bigger body than what we had prior, and you can see its near-term line coming down too. And then the Russell 2000, very similar type pattern. It hasn't been as bullish. Its near-term line is below 50. And its intermediate line was just barely getting going. Its moving average hasn't even turned green yet. So obviously you can see, and we're actually back. We closed back below the 78% retracement level, whereas like on the NASDAQ, that would be like a close way down here on the NASDAQ. That we're just not to on the Russell 2000 because we haven't gone up as much, right? So that kind of gives you an idea of how far away and the margin of safety these NASDAQ stocks have relative to those small cap stocks. Now let's take a look at their Hakinyashi candles on the weekly basis, and you can see long upper shadow, lower shadow. So that can be a transitionary type pattern. So we'll keep our eyes on next week, and especially with how high that PPO is. Same thing on the NASDAQ, right? Big candle there, and of course the Russell 2000 is giving us almost a picture-perfect transition candle. So we might be in transition mode here, from bullish. And not to like fall off the cliff bearish, but just to 23% retracement, maybe a little bit more. I actually don't think we'll get that type of 38% retracement even on the S&P 500. But I do see us coming back down into this kind of area, just a smidgen below this 40-week moving average before we get going again and bounce back up by the time all is said and done. Obviously, we don't have 3 green arrows anymore. We have 2 red arrows. A big jump in volume the last couple of days. In fact, if you take a look at the 2-line version of the chart here, we actually we barely closed below the 17-day by the end of the day. Obviously, the MACD and stochastics are down and falling. But man, that's, again, so that's why I say, like, Are we going to bounce right back up early next week? Very well could, because you get below the 17-day moving average. This isn't the first time we've done this. You expect that we'll bounce right back up above it. And when we don't, that's the cause for concern, right? That the trend is, this bullish trend is over and we're exhaling. But keep that in mind that, while we might, even by September expiration, we might still be a little bit higher at some point in time. A real pullback will be coming. Let's take a look at some of these other oscillators here really quick. The other thing too that stands out is while the negative directional index on the DMI crossed above 25, the positive index is still well above 25 too. So when it gets below 20 is when you start to worry about an actual pullback occurring, and that's not the case. The RSI as well, like again, getting below 40 is the sign to watch for, and we're not even below 50 on the RSI. Getting below negative 200 is the sign to watch for here. We're not even below negative 100. So you get the sense here that, this has been a very noisy drop, and we're not even below the value area here, which is a smidgen above the 23% retracement level. I mean, that's all we did was we came down towards support and we bounced with a very noisy move. Not bullish, not bearish, noise, just noise. And the other thing too, speaking of noise, that brings us to our noise balance indicator. When you're worried about the trend being done is when this drops to 0%. And we have not done that yet either. We have not dropped to 0% either. So a lot of things here from a technical perspective that we're just not seeing. I told you before on Wednesday night even how you could quickly fall to 338 where the point of control is because there's just very little volume. Well, now guess what? There's very little volume above us, and that's how easy we can come right back up to 355, maybe 350 to last week's high point, but 355, maybe even up to 360 because there's not very much volume up there either. If we can clear that little the value area as well as clear that little volume node up above the value area. Whereas on the downside, again, that's why we stopped where we did. There's some support in there, but keep in mind, if we don't hold that support, let me go to an hourly chart here. This is the 90-day chart. If we don't hold that support here at this node, for whatever reason, early next week, then you can see how easy it would be to fall to 320. In fact, we almost will, and that is a 23% retracement, a little bit below that, and then you can expect, potentially move down a little bit lower or down to the 305 or whatever, but there's going to be some strong support, and that's where you would expect us to fall down to, because look at the very little volume in between that spot. Let's take a look at volatility, as that was our other thing that we've been watching for, is this jump in volatility, and there it is. But you notice it did not get above to the 100% mark. So again, not a pullback, just noise. The 90% level can act as a resistance when you're in a bearish mode or bullish mode, which is what we're in right now in the markets, obviously. And that's all we jumped up to was 90%. As much as we jumped up here on an absolute basis, we didn't jump very much on a relative basis. In fact, we're almost right back down by the end of the day today to the sweet spot for the bullish territory. So again, it kind of shows you, but it does kind of, you can see the, what's going on with the VIX getting up above here yesterday, up above the Bollinger Band, working a little bit back below the Bollinger Band here today, but you see the movements going on. This is the weekly. At the high of the week for volatility, we're up to the upper band, but you can see the pop that's setting up here. We're setting up for a pop in volatility. That's one big week. Is that enough? Is that it? And we come back down, or do we have a little bit more left to go? Right. That's what remains to be seen, especially considering that we haven't really popped up enough. Even that pop got us up, by the time we opened up the next week, above the 105% mark. And then we came back down. So volatility remains high. It remains high on a long-term basis as well, as you can see over here. And it remains high when you look at the skew, right? I mean, a little bit of a drop here, but the skew is still at a higher level than it is lower, which again suggests that people are a little worried about tail risk. Volatility is still high out in time and out in strike, because people aren't worried about the market coming down a little bit. They're worried about the market coming down a lot, and the time frame, the catalyst everyone is looking towards is in that 3-month period, and that's the presidential election. And so that's what everybody's kind of keeping their eyes on, and what's keeping volatility elevated. And things like today will be a lot more skittish over the next couple of months as different things come out. So to summarize my technical outlook, the trend's still strongly bullish. This was not a pullback. The only people who think that this was a pullback were people who were too bullish going into it, right? If you were still too bullish, if you were more bullish, this early this week than you were a few months ago, chasing this 5-month-long intermediate rally, then yes, it's a pullback for you. It's a pullback for the weaker hands. It's not a pullback for people who have been decreasing their exposure, like we've been talking about in this video for like I said, the last few weeks. Decreasing our exposure, specifically decreasing our exposure to the tech sector because of its worse margin of safety from a technical perspective. So we had a little bit of a before shock today. I don't think this is the actual event, though. I think it's still coming, and don't get suckered into any kind of short-term bounce we might get as early as next week, thinking that that's it, and here we go for another month or 2 or 3 to the upside. Obviously, volatility markets and option markets are still got their eyes on that November time frame, and you would not expect markets to get less volatile between now and then. And so what do you think? Do you agree or do you disagree with that sentiment, that outlook that I just gave you? Comment down below, especially if you disagree. What are you seeing that either makes you a lot more bullish or a lot more bearish than I am? Maybe you think this is it. Maybe you think that was the pullback. Whatever the case is, I've shown you what some charts that I've been looking at. Now you share what you're seeing that drives what you're thinking there. All right, now let's take a look at what's driving the price action today, and let's just take a look at this week here. What a fascinating week it was, right? So we'll go over here. I guess we have to go to that August 31st till now. We'll go to a 15-minute chart. So risk off day, to say the least. The Qs were the biggest winner along with bonds. So that was the chart we saw on Wednesday, right? And we were like, oh, that's a weird combination. Well, bonds fell too by the end of the week, but so did sharply the NASDAQ. NASDAQ went from about a 3.5% gain to at one point in time for the week a 7% decline before bouncing up at the end of the day to only finish down 3%. And it was broad-based. Small caps fell. Qs fell more, not surprising. S&P fell. Emerging market stocks fell with the dollar being up on the week. Bond yields, interestingly enough, rose for the week. So that was something that we were kind of keeping our eyes on here. Let me pull up the bond yield. So you can see today a big sharp jump, a big decline in long-term bonds here today, and a big rise in yields. Very, very good sign. We don't have a dark green shading yet, but you can see back to a green line after this light pink shading yellow line pattern we got yesterday. Nice little bounce up to the upside. Very steeply oversold short-term sentiment too, and so far bouncing up pretty nicely. We'll see. I mean, we had a bounce up there, and that got us to a cluster before the pullback. So we'll see how that plays out. But on a day where we're pretty oversold from a risk appetite standpoint, that long-term bonds didn't sell off. Now, granted, long-term bonds had already sold off, or bonds were already bought up, and probably in anticipation of this. The first few days of the week. So kind of a buy the rumor, sell the news, so to speak, on yields. Of course, the other impact that we're seeing is on the dollar. The dollar itself, you can see after being so extremely oversold here. In fact, let's take a look at the euro-US dollar currency pair. After being so extremely oversold relative to the euro, which is its main currency counterpart, you can see where the dollar kind of had a really good week this week and came back down. But you notice it's not down to its 23% retracement. So on any kind of intermediate decline in risk appetite that we expect will happen at some point, that will be most likely the dollars move back up. Now, whether or not that will change the trend or not remains to be seen, and I don't expect that it will. But keep that in mind. You got a little bit of a triple top type of head and shoulders pattern developing here, and we'll see if that plays its way back down towards 115 on a little bit deeper of a retracement level here. Take a look at crude oil as well. But first, gold. Take a look at gold, and you can see light pink shading and a yellow line Dark pink shading today, a little bit of a drop, more of a drop in the intermediate line on gold prices. And then, of course, crude oil, which has been flat as a pancake, like no moves at all, finally does get a move, and it's a pretty decent 4.5% drop to the downside. So a little bit of a breakout pattern, as you can see on its Bollinger Bands, even more. Very, very low bandwidth, and look at that big drop below after getting to this volume node. Still above, still in the value area, hasn't broken below that yet, but significant decline to say the least this past 3 days after really not much of a move at all previously. So not getting the breakout as of right now to the upside from this really low bandwidth, instead getting a breakdown to the downside. Again, can we expect that? Yes. In the case of a more of an intermediate pullback, that's definitely something to kind of keep an eye on, because again, can we fall down to 35? Down towards that volume, that point of control, even down to the 38%, definitely is a possibility over whatever time frame, this pullback in risk appetite eventually occurs. All right, now let's take a look at the sectors and how they did this week. And obviously we can get an idea of how they performed. Let's just go to a 15-minute chart as well. And you can see technology, big loser, communication services, after being the big winners early this week, along with utilities and materials, interestingly enough. They ended up coming down sharply, along with energy, not surprising either. And then, of course, discretionary down here, and up at the top, holding their value because, they dropped too, but holding their value better because they have better margins of safety, are these industrials and financials and materials and all the other safe haven areas that you would expect to outperform during a decline like this. So, the more, if and when we do bounce up, expect these tech sector, this tech elements to bounce up the most. You can see, as bad as this week was, that's the drop that the Qs, that little drop right there is all that the Qs came down relative to IWM today. So, again, during any kind of intermediate pullback, we might come down towards this 200-day moving average, which is at 1.63 right now. But you can see, like this, there isn't going to be any kind of great rotation. We still will expect technology stocks to kind of lead us up after the pullback, even during and after the pullback. But during the pullback, you might get a little bit of outperformance in the tech sector, but that's probably it. And then I fully expect us to get up towards this 2 level again, 2 handle, and some kind of divergent high point here before we really start. Because again, when this comes back down like they did over here, it's not going to be during a bull market. It's going to be during an actual bear market. Not a stealth bear market like we've had the last couple of years, but an actual bear market where we are in like death cross environment on those long-term moving averages for months, right? So now it doesn't necessarily again mean that we're going to have 2008, October 2008, because even 2000 until 2001, until September and 9/11, 2001 was kind of an orderly decline. We weren't falling off a cliff. It was 2011. 9/11 caused a little bit of a shake-up, and then 2002 is when things got a lot more volatile, and that was the end, right? We retested lows in early 2003, and then we got going from there. So not every pullback is going to be like COVID, right? 34% in 4 weeks, or like 2008 where we dropped 50% in a year because of big financial bubble burst. No, like in 99, 2000, we had a lot of tech spending pulled forward. And so you had an orderly decline after that because you had all the spending pulled forward. And we've had a very similar phenomenon here where we have a lot of spending pulled forward because of COVID, because of 5G, because this race for vaccine, for this race for this all going digital and working from home, which is not just a short-term thing. It appears to be more of a eventually a long-term thing for some companies as they use this disruption to find better ways of doing things, instead of just doing things the way they've always done things, saving costs and increasing productivity and things like that. One of those areas that's actually been holding up during the decline to a degree is home building. Excuse me. Home building stocks like D.R. Horton. So if we take a look at its stock, It came down, light pink shading, yellow line, pulled below the moving average, a little bit of a bullish divergence on the near term line. Has not dropped below 50 yet. Like I said, light pink shading, yellow line is a good bullish pattern. Take a look at its 3 green arrow chart. It also has 3 red arrows now. Sorry, let me pull up that arrow chart first. It has 3 red arrows. And I know that that's, you would think 3 green arrows is a buy signal. Like this one, but so 3 red arrows should be a sell signal. And the reality is 3 red arrows is almost a better buy signal than 3 greens are, because you're forming the low point right now, or will reverse, right? So that's why you've got a really good reward risk ratio, because you'll know really quickly if we don't bounce, and if like this one over here, like when we don't bounce. But if we do bounce, you can see when we got the 3 red arrows in these areas, you bounce back up, you get a good run to the upside. Could that be the case here? Again, the upside potential for a lot of these stocks isn't very much, because we haven't had a pullback yet, right? We've been bullish for so long without an exhale. We haven't even retraced 23%. How can we go back up significantly through zero? We can go up a little bit, but how can we go up significantly through zero until we've exhaled, right? You can't just inhale forever and have shallow exhales, because that just leads to obviously hyperventilation eventually. But you can see there's opportunity for it to go. From a volume standpoint, there's as much opportunity for it to go up as there is to go down. And if it does go down, there's pretty decent support down here to the downside. You can see it's RSI and CCI are, we dropped down, but we didn't get below 40. We didn't get below negative 200 here. You look at its DMI pattern here. We didn't drop below 20 on the positive index, and the negative did get up. Still not above 25 either. So, I mean, there's a good opportunity for this to bounce. And again, if it does, I don't think it will bounce very far. And until we get our broader market exhale, probably most likely by October expiration, we'll be at least into it by then. So we have opportunity for it to go up and down. So the nice thing about options is you can trade both directions at the same time. And that's what we did in today's technical analysis class. We went over here and we said, okay, let's sell the 62.5, buy the 60 put, sell the 77.5, and buy the 80 put. They're relatively large spreads, so you have to kind of play with the spread to get in. And we ended up getting in, I believe, at a little bit over $1, or right around $1. And then now there's our strike. So our strikes, there's our return normal risk. To get about a $700 reward for a normal risk. That means I can lose up to $700 on this, and then there's my break evens, right? So if I look at where we are here, my break even in one direction here. Let me go to a 90-day chart. So my break even in one direction is up here on the top, so a little bit high, a higher level up to the top, and to the downside, we've got this very strong support right below us. But that's how much room we can go down. So a little bit of a support at the 23% retracement if it holds, but I'm expecting that we'll go up first and then work our way back down. And by then we might actually have a better support, a stronger support, if we build up some volume here before we end up going up. All right, and that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the upper right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to others' threads, and let's keep this conversation going in between videos here. And again, thank you very much for watching our video tonight. And remember to hit that, subscribe to our YouTube channel, hit that thumbs up icon on Twitter and on Facebook as well, and then comment on our video. Follow us on Twitter for more content between the videos. Join our group, our Facebook group that we've created, as well as our website at marketscholars.com. Again, thanks. Have a great Labor Day weekend, everybody, and we'll see you all on Tuesday.